In today's video, we will be talking about one of the easiest patterns to spot and trade while looking at charts, the head and shoulders and inverse head and shoulders patterns. In trading, we often are overwhelmed by the amount of information we are constantly looking at, and sometimes overthinking can lead to bad decisions as we trade. So let's go over one of the more simplistic trading strategies that can be pretty accurate in predicting price movement. A head and shoulders pattern is a common technical analysis chart formation that signals a potential trend reversal, occurring at the top of an uptrend and indicating a shift to a bearish downward trend. The pattern is characterized by three price peaks, a higher central head and two lower, similarly sized shoulders on either side. The pattern is confirmed when the price breaks below the neckline, a support line connecting the low points between the peaks. Its upside-down counterpart, the inverse head and shoulders pattern, signals a bullish reversal after a downtrend. Components of the head and shoulders pattern. Left shoulder, a peak that forms after a significant uptrend followed by a pullback. Head, a new, higher peak that forms after the pullback from the left shoulder, followed by another decline. Right shoulder, a final peak that forms at a lower level than the head, similar in height to the left shoulder, and also preceded by a decline. Neckline, a line drawn by connecting the lowest points of the troughs, dips between the shoulders and the head. When the price breaks below the neckline after the right shoulder forms, it signals the end of the previous uptrend and the beginning of a new downtrend. Now let's get into some real examples of each pattern. First, I'll show you a head and shoulders pattern on Eli Lilly stock. Now, this wasn't an intraday formation of the pattern, but a formation over the course of a month or so. But the rules still apply. Now, this isn't a live replay of the trade I was in, but I thought it may be easier to take a look at the big picture versus looking at each candlestick individually. So as we take a look at the chart, we see the formation of the head and shoulders. We identify the left shoulder, the head, and right shoulder, and we identify our levels accordingly. Note that just because we see the formation, it doesn't have to follow the downtrend just because the setup is there. Of course, intraday would be a little more nerve-wracking to decide, but again, that's why I think looking at the bigger picture will boost more confidence in taking a trade versus trying to intraday and get stopped out by setting stop losses too early or getting stopped out on a retest or something like that, which has happened to me plenty of times. Which could have happened here. As we see, it did retest the neckline for a possible support and a rejection of the downtrend, but as we see, the sellers won and the downtrend did confirm. Another way to confirm the bearish reversal is to look at the volume. And when we do, we see a big volume spike of sellers at the neckline retest rejection that are driving the price down, which should give you even more confidence to enter a short and ride the wave along with them. Now on to an inverse head and shoulders example with Meta stock. Same rules apply, but just in the opposite direction. Same anatomy of the trade, just the opposite formation of the pattern, and now a reversal to the upside versus the downside. Now with this trade on Meta, this was intraday. I was on the 1-minute time frame to see this, which doesn't necessarily have to be a constant. You can look at whatever time frame you'd like, but higher time frames like 45-minute or 1 hour, you won't really see the pattern formation intraday. Now, admittedly, I didn't catch the full extent of this trade as I wasn't really paying attention that day and set a tight trailing stop loss, so I got stopped out about halfway of the bullish reversal, which I was very disappointed in. But hey, profit is profit, and it boosted my confidence that I entered the trade in the first place. I bring that up solely for that reason. I am no expert by any means and still learn day to day. But with trading, we often get in our heads about missing out or FOMO or just losing in general. But when you can step back and see you had a good setup and executed, whether you got out early or lost some on a tight stop loss, if you look at the bigger picture at the end, you can take notes on what happened and adjust accordingly. Building confidence in yourself makes you a better trader. Now, taking a look at this chart from Meta, it was about as perfect as an inverse head and shoulders pattern can get formation-wise. So we start off the same with marking our left shoulder, head, and right shoulder. Identify the neckline, and we watch what happens on the end of that right shoulder. If it has a clean break past the neckline, then perfect. Or if it has a retest of the neckline, like it does in this example, then same as before, we watch the price action. As we see the formation perfectly, now we wait to see if it's confirmed or not. We watch the retest of that neckline, and we see the buyers broke through, and it is now pushing up to the upside for continuation. Again, looking at the volume for another way of confirming your thesis is always a good idea, and we see a big volume spike of buyers. So to me, it's a green light to enter the trade and ride the wave to the upside. So with looking at both of those examples, let's recap what we went over. A head and shoulders pattern is a common technical analysis chart formation that signals a potential trend reversal, occurring at the top of an uptrend and indicating a shift to a bearish downward trend. The pattern is characterized by 3 price peaks, a higher central head and 2 lower, similarly sized shoulders on either side. The pattern is confirmed when the price breaks below the neckline, a support line connecting the low points between the peaks. An inverse head and shoulders pattern is a bullish chart pattern in technical analysis that signals a potential reversal from a downtrend to an uptrend. It is characterized by 3 troughs, a central, deepest trough known as the head, flanked by 2 shallower troughs on either side called the shoulders. The pattern is confirmed when the price breaks above the neckline, a resistance line drawn between the peaks after the left shoulder and the head, often accompanied by an increase in trading volume. Note that if you see one of these formations on a particular stock, it doesn't mean that stock will either crash or pump indefinitely, as the trend can change on news or anything regarding the market and politics. So use your stop losses and take profits accordingly. Hopefully, this video brought some type of clarity if you were questioning how to trade these patterns or just brushing up some review. Either way, I thank you for watching, and I will try and get more videos out like this as soon as possible and be steady with my upload time. Also, drop any suggestions you would like for me to cover in the next video. If there is anything someone is struggling with specifically, I would love to help you out. Stay safe out there in the markets, guys. See you in the next video.